Okay, welcome everyone. It's 2 o'clock on the dot, and it is good to be here. So look forward to spending some time with you, sharing some ideas, and kicking back and looking at some of the new tools that we've been developing and sharing with some case studies. And I'm going to go ahead and bring over our little presentation. We'll start off with that, and then we'll move into the software. I'll assume that you guys can hear me fine, and in the chat room, that's where you would chat some questions if you have them. And if somebody wants to send me a quick chat that just says you can hear me okay, that's great, and I'll launch on into things. You hear me now? Can you hear me now? Yes, okay, good. Thanks, Charlie. Okay, all right, so we'll kind of pop in here, use this to help remind me. We talked a little bit about the core concept here behind the software. How do we help you convert the prospects that you work so hard to generate? How do we help you, whether you're a financial advisor, a loan officer, a realtor? We have all different types of folks using the platform. At the end of the day, I'm going to continue to repeat this because I think you can make your business very simple in a way by concentrating on these 3 questions. We know that they proved to increase your conversion rates dramatically. You can adopt them for different situations, but at the end of the day, in all of our case studies and all the things that we look at, we're always going to look to answer 3 simple questions. Does the individual have the cash right now for this to work for them? Do they have the cash flow? In other words, are they going to be comfortable with a monthly payment? You can pay off a mortgage from 30 to 10 years by paying an extra $1,000 a month, but if the client's not comfortable with that cash flow, it may not be good for them. And what's the net impact of their cash and their wealth over time? And that's a critical part that is going to become much more important over the next couple of years in this industry as it relates to suitability. So we got to be fast, easy, and accurate. Deliver clarity and confidence. Why? Because with clarity, people become more confident. And in that confidence, that leads to quick action, which is good for you, good for the client, good for everyone concerned. So we were going to look at a couple of different things today that I thought would be of value. One being the new closing cost format. So let me bring the software over and go through and kind of show you a couple of things. Let's see, I'm going to just click create a new plan because I like to reinforce just some of the different simple aspects of the plan. I'll just say refinance. I'll call this a webinar client. And we'll say their income is $100,000 a year and they enter a 30% tax bracket. And we'll just put an email here. Remember, the red lines are your kind of speed lines. This could be a sample to show closing costs. And you'll notice again, this is all showing up here. These are your top 10 most recent cases. Your speed boxes are the red boxes. I only have 5 boxes, 6 boxes to fill out here. I'm going to put in a liability. So let's put in a new liability for this particular client. And let's say they've got a mortgage. And I'm just going to make this one up. We'll do some case studies in a little bit, but I want to mainly show you the closing costs. Primary residence, 30-year fixed, bank. Let's say the original loan amount was $180. Start date was 3/1/2010. Interest rate 6%. Current balance, let's say, is $180,000. They've been paying interest only on this loan. Okay, so we got our important objectives box down here. Always important. And let's say this person is wanting to refinance, doesn't want to spend much out of pocket, would like to see if it makes sense to refinance. Okay, I've got my referral partner here. If I want to add a referral partner and assign this to a particular partner, which I'm going to do, because I want to show you the referral partner stuff and as my marketing tip today. We're going to talk about that. But let's just go in here and let's just assign this person to a financial advisor. And then, of course, you've got your follow-up comments down here below. if you want to type in a comment, first spoke today. Maybe I want to just do that, add the comment, just so I kind of know when I had that first contact. And I can shrink these up and get them right out of the way. So nothing's changed here. I just want to do a quick refresher. Again, this is setting up the Manage tab page. When I go to the Borrow tab for this new transaction, what you're going to see that's going to be a little bit different down below is the closing costs. We got some great feedback from different folks about how they wanted to simplify the closing costs a little bit. We only were going to show the closing costs that were relevant, so if you added something or didn't add something, it would take it away. We also wanted all of our analytics to be done for you. So you'll notice for the 3 questions now, all of the analytics for each of the 3 question panes are completely filled out, or I should say calculated. And what we've done is we've moved the closing costs into the widget box up here. So if this was a brand new client, and I was just sitting here with this client now, I'm looking at a 30-year fix for simplicity. I got a $200,000 mortgage and it's recommending a 7-year R. I'm going to override that and just say, let's go with a 30-year fixed at 80%. So 80% based on a $200,000. Let's see what I do. Let me take this to 180. And I'll put in 4%. Okay? So what's different about this now is the payment here, when I click this box, my closing costs and all of my monthly fees are on the same little widget, so I can set these up. Let me tell you why we did that. It gave us more control and gave you more control on how you set up your closing costs. It also means now that when I set this up, if I click duplicate 30-year fixed, it's going to copy everything down for me, not only the program here, but the closing costs. So let's just say in this particular situation, the closing costs were going to be $3,000. And I just want to do a really simple presentation of this client closing with $3,000 in closing costs, and I click the Save button, and that's it. So you'll notice below now, I've got my current, and I've got my 30-year fixed, and it says, no, and we decide to put in origination and discount, so even if there's not a cost there, we still put those in zeros, because it's a good selling point to be able to tell the client, you know, we're not charging you origination, we're not charging you discount. We estimate about $3,000 in closing costs. Remember, this is a pre-GFE sales tool. The goal here is to sell the client, to make the presentation, to get them excited before you jump into all the intense paperwork. I've had some emails come in about, you know, doing good faith estimates first and getting all the closing costs and stuff. And I'm like, yeah, but I mean, that's a lot of extra work when a client isn't sold yet and moving forward. You know in your market about what it costs to close a loan like this. Maybe it's $2,500, maybe it's $3,000. Remember, this is pre-GFE. This is where you're just doing a sales presentation to the client. So I can put in a number here that I'm pretty comfortable. I know in North Carolina, it's about $1,780 is a typical closing cost. So if I'm going to charge an origination fee, that would be on top. But I just put in a generic number. It's red. Closing costs are $3,000. There's no cash at closing. So I know that this client's going to have to come out of pocket $3,000 the way I've set this up. I can go ahead and answer the key questions, though. Does this make sense on a monthly basis? Yeah, he's going to free up $220 a month. And if I go down to the lower section here, I can see based on the monthly payment over the 7-year time frame, and it's pulling all of my defaults from my defaults page, the appreciation rate of 2%, the tax savings rate of 5.1, the 7-year time frame. These are just the defaults that I use often. There's a $25,581 savings. So we're going to play around with some of these numbers, but what I want to point out in this first sort of part here is by doing it this way, let's just say I want to compare that to having the closing costs rolled in. So I click duplicate 30-year fixed. And notice what this just did. This brought all of this information from above in here as well. When I click on this, all of this is in here as well. So whatever I filled out is going to bring down. So I can create one scenario and click duplicate, and now I've got 3 exact scenarios side by side. But with this one, what I want to do different is I'm going to go in here and say include these closing costs in the loan amount and click save. So now when I do this, notice now what the software does is it recalculates your loan amount. And notice when you see the closing costs, I've got closing costs of $3,000. Total closing costs are $3,000. Cash at closing is positive $3,000. So my cash needed to close here is 0. So with, again, what I did is 2 clicks, and I've now got a side-by-side comparing one 30-year fixed with closing costs and one 30-year fixed I'll call no closing costs. It's that simple. Now I can look at the payment difference here. What's the payment difference? $220 versus $205. So no out of pocket, you still save $205 a month. And is this still a good thing for you over time? Let's look over 7 years and see if this makes sense. You're going to save $25,000. You're going to save $24,557. So only about $1,000 difference in savings over a 7-year period. So another reason that this is critical, because we talked about the paradox of choice in our last scenario, is I would prefer to do this kind of an illustration because I'm giving a choice now between the 30-year fixed with closing costs out of pocket and the 30-year fixed with no closing costs. And I want them to be able to pick which of these do you like the best. Do you like having no closing costs out of pocket and save $205 a month, or pay $3,000 a month and spend and have an extra $220 a month? You know, most clients would look at this and probably say, wow, I think I'd rather go with a no closing costs and save $205. And then I come down below here and I can see I'm still saving relatively the same amount of money over that 7-year period. It's not a big difference. So that's the closing cost enhancements that we've made, and I think you're going to find as you go through and do purchase or refi scenarios, this is greatly simplified now. And it's also going to be much easier for you because when you set up your case, let's say I wanted to do one more for some reason. I wanted to show him getting, and I'm not, dealing with MI or whatever here, but let's say that I wanted to come in here and I wanted to add a lender-seller credit of, or let's just say maybe I'm going to pay a half a point back to the borrower, right? I can add that in there and you're going to see that show up there with lender-seller credit. And maybe to do that, though, it's going to cost him 4.125 in rate. So now I change the rate. Again, just 2 clicks. Now you're paying $3,000, you got nothing, or you're walking away with $900 in your pocket. 220, 205, 192. I can see the payment difference there is dropped to 192. In this scenario, 25, 24, 23. I can see my savings is going down as well. But you can see what I want to illustrate here is the fact that you can easily add these or subtract them. Maybe he says, I really like, this no closing cost. If someone says that, I'll tend to move back to this scenario. I'll shrink that down and say, okay, so let's just look at this 30 with closing costs versus this alternative, a little higher rate, but you're walking away with $1,000. I still, whenever I can, like to give someone a choice between 2 scenarios compared to it, because I've already really got 3 choices here, current, this, or this. So I'll use the 4 sometimes when I'm building a case, but usually when I'm developing a report for a client, advisor I'm working with, etc., I still tend to always come back to these 3 scenarios. And again, remember, if I want to shrink up current and just compare the 3 scenarios side by side, I can do that, and they're going to be compared against each other. I just shrunk the current liabilities, and now I can compare these side by side and see on a relative basis, this is an extra $15 a month. This is an extra $28. Depending on what you're most comfortable explaining, you might not want to bench line off the current. You may just want to show each scenario here and say, which of these do you think you like the best? This is going to save you this. This is going to save you $1,000 less. This will save you $1,900 less. But we're always going to benchmark off your left column. So if you if you collapse current liabilities and 30-year fixed and compare these 2, we're going to always compare against your first column here. This one is going to be compared now all the way down to the bottom side by side. So that gives you a tremendous amount of flexibility in how you design or build your particular plan. So let's go back over and let's go back to our PowerPoint here and look at the next thing. And the next thing is escrow refunds and break even. All right, so one of our users, they may be on this call, had an interesting point. And they said, sometimes with my clients, or a lot of times with my clients when they're refinancing, they are paying escrows, and those escrows are going to come back to them. So I want to be able to show that in the wealth impact. So what we did here, and there's another thing we did here, is you'll notice several of these closing cost things are fixed and several are open. So this gives you more flexibility. Some people wanted to call this prepaids. Some people wanted to call this escrows because that's what they're used to. And let's say in this situation, this client was going to escrow $2,000. All right, so I click Save. And let me just, I want to make this simple. We'll just compare the current that they're doing today to this new 30. And I put in 2,000 escrow. So now you can see the client's paying closing costs of 3,000, but they're escrowing 2,000. So they're going to have to come to the closing table with $5,000. But most of us know that if they're escrowing 2,000, there should be 2,000 coming back. But they're not going to have it at the closing table. So we want to be able to say, these are your closing costs. This is what you're going to pay now. But I want to show that you're getting that 2,000 back in the form of an escrow refund. The other thing that does is it helps me with my break even and my wealth impact below. So what we decided to do for this user and obviously for you is now underneath the little boxes here for the widgets, when you say add a new payment, one of the new choices is escrow refund. So I can come in here and put $2,000 escrow refund and click Save. And what we're assuming here is now what? That at closing, you've got to pay $5,000. But what are you getting back? You are getting back an extra $2,000 in the form of an escrow refund. And that flows into your payments here. If I expand my payments, you'll see it says escrow refunds, $2,000. So you're getting that back as a credit. So notice that the savings here, I'll make this 0. The savings here for this particular client are going up now by over $2,000. That'll also affect the repaying because I can apply that extra escrow refund if I want to towards repaying the liabilities, which would help to repay those liabilities even faster. So essentially what we've done, remember on this little widget button, you can add an at closing payment, a one-time payment, a monthly payment, a rent income payment, escrow refund payment, and you can add as many of these as you want to your mix. But now you're going to be able to show the client a faster break even, assuming they're getting that escrow payment back. We made this optional because they may want to spend their escrow refund, or you may not want to apply that. But from a wealth standpoint, if they're paying $5,000 in closing costs, but $2,000 of that is something they're going to get back, then you can now show this, and you want to show this to do an accurate wealth impact scenario for that client over time. And when you go to do your report, let me just go over to the present page, and I'll click on the 2-page simple summary as a PDF. Bring that up. Say open. What's cool about this now is the break even in months here. And this is what the person caught, is that they had a large escrow payment and it was extending their break even months out to like 16 months. And they were like, no, it's not going to be 16 months. It's going to be 10. But the reason that they couldn't figure out why is that they weren't showing that escrow refund coming back into the client. So now that's reflected. And we're going to talk about break even in a little bit, but that's going to flow here through on your break even, which is pretty cool. All right. So just going through some of the recent enhancements, changes, and this was just a break-even scenario like we just looked at there. So your break-even is a powerful number. We are going to add the break-even to the 5-page reports as well. Because we've made the closing costs smaller, we now have room to add that. So whether you do a 2-page report or do the 5-page comprehensive report for your client, we're going to be adding that break-even in months number down at the bottom. So you can see what that wealth impact and what that break-even number is. So let me talk about that for a second, the break-even. The break-even number is somewhat unique in that most people just calculate break-even by taking the monthly savings that the client is going to be getting and dividing that into the closing costs. And that's not accurate because closing costs are tax deductible in some cases. The mortgage payments are changing every month. Tax deductibility is changing every month. Appraisals and property appreciations could have an impact on the break-even if you're buying a new home. So think about that. You're selling a $200,000 home and buying a $300,000 home. If property appreciation is 2%, The $200,000 home would have gotten a $4,000 appreciation this year. A $300,000 home would have gotten a 6% appreciation, or $6,000 appreciation based on the same 2%. So that appreciation is usually a wash, but in some cases has an impact on your break even. When you're renting and you go to buy a house, that has a huge impact on your break even because your renting is building no equity and then buying is building equity. So when we started looking at break even, we base our break even off of wealth impact, because wealth impact is the point at which your numbers go from red to green, is the point at which you have a break even from a wealth perspective. So what's really going to be cool about this is you play with it and start looking at that. You could have a nice conversation with a client about their decision to move forward on a transaction and what is the break even for this client. So this client today is going to be, doing a transaction, let's say where they've got to spend $5,000 out of pocket. That means their wealth impact is negative $5,000 at the closing table. Remember, 0 years is closing table. And this is a wonderful thing to remember, because you may have a conversation or an opportunity with a client, and if you're going to talk them and walk them through this is closing table. This is, if you do this transaction and we close on it and you change your mind a month later and you don't want to do the transaction, I mean, you're out the $5,000. That doesn't make a lot of sense. So if I go forward to 1 year, bam, positive 721. All right. So this client has actually, from a break even standpoint, broken even in the first year in this transaction. All right. So how is that possible? Well, because we're crediting back, the $2,000 is prepaid and their real closing cost was only $3,000, and you've got $220 a month, plus you've got some possible tax savings. But this is taking that wealth impact number and showing you the point at which that client breaks even. And it's really cool when you look at especially loans with larger loan amounts and different closing costs and stuff. Sometimes it's 12 months, sometimes it's 16, sometimes it's 28, sometimes it's counterintuitive. But this wealth impact number here, when it turns green, is the point at which that scenario is going to make a break even. Now, when we do our rent to own scenario in a minute as one of our case studies, our rent versus own, I'll show you how that really can play out and be interesting. But your break even is always calculated off the point at which the wealth impact turns green for that particular scenario. So if you have multiple scenarios in here, you'll see that the wealth impact number may get there faster for one than another. And that's what you want to be able to see. Which of these is going to get there the fastest for that particular client. All right. Let's see, if we could put also the mortgage payment that may roll into the loan. Jeff, I'm not sure. Let's see, what do you mean by that? If we could put also the mortgage payment, they may roll into the loan. You got to tell me more, because that doesn't quite compute. If you put a rate of return, would that reduce the amount of time to break even? Absolutely, but it wouldn't necessarily if you were repaying. It would do more so if you were saving. And if you were saving at a particular rate, say 6%, all right, we know that starts to affect what? That starts to affect your wealth impact, because that means any extra cash or cash flow that you have is going into a savings account now, and you can see that balance. So the higher return you get, the more money that's going to be in that savings account over time, and the faster that person's going to break even. And that works both ways, right? If it's negative, or if appreciation. I've had some people say, I got a client buying a house, but they want to assume that the property goes down in value 2% a year. What would their break even be? You can model that with our software. Because look at that. Let's say I make it negative 2% a year. Okay. You can go through, and let me just take this out here, get it back to the same scenario. Then it's not going to have an impact on this one, because the appreciation is going to be the same. So if if your house goes down 2% in value on a refinance, it doesn't have any impact. But if it's a purchase scenario where maybe they're going to buy a house and they think it's going to go down in a year or two, that becomes a neat scenario, because you can still say you'd be break even in 4 years, even if your property value went down 2% a year. So you can model it. I've had people even say, I want to assume that I don't get a very good return. I get a negative return on my investment, and my property value goes down. You can model that on a comparison by comparison basis. These aren't changing. These aren't changing because it's the same loan, the same house amount, on a relative basis, there's not a lot of difference here because we're repaying. If I go to saving, then you'll start to see a difference here because now the money's going into a savings account and it's being affected by the after-tax savings rate. Jeff Younger, where you are putting the escrow refund, would it also make sense to add a mortgage payment they did not pay? Oh, okay, I got you. Yeah, you sure could. So you're talking about like the mortgage holiday. So maybe the client is also saving their mortgage payment, which was going to be 1079, because they're refinancing, and I want to make that as a one-time payment right now. So Jeff's saying if I want to go ahead and show that cash flow savings factored in right now, you could put that in and say you're going to get the escrow refund back, plus you're going to get that cash flow savings of 1079. Remember, if you don't refinance, you're going to make 12 payments this year. If you do refinance, you're going to make 11, because your payment, you're closing in May. Your first payment is going to be due in July. So you've got sort of that mortgage holiday on a cash flow basis. Let's take that extra cash flow holiday payment and throw it in here as a one-time payment as well and see what that would do for you. And you could see, obviously, we were at 240. That dropped it to 238. So that took another 2 months off the term of the mortgage for that particular client. Many times we have them miss 2 payments to save out of pocket. How could this be reflected? We have them miss 2 payments to save out of pocket. I'm sorry, I'm not quite sure I follow that. But it may be the same sort of a thing. You could put that in there. Because again, see guys, you can add as many of these payment things as you want to. If I'm understanding you correct, Charles, and you want to say, I want to show that these 2 payments, that they're missing, could also be applied. You could do that. Now you're showing the escrow refund and two payments of 1079 going in there as well. All right. Let's see. Any other? Did you put the origination date to the current point in the AM table is used for the comparison of future wealth? Yeah, it takes the origination date. It takes the date on the managed page here. So when you put in the details, I put in start date here. So that is your start date for that particular loan. And it's going to baseline that start date off where it is today and then compare that going forward. So if you're 6 years into a 30-year mortgage, you've only got 24 years left on that mortgage. And then we're going to compare going forward against your new mortgage. And that's what the AM tables meant as well. Okay, good, Charlie. Got your question answered. Good. All right, cool. So let's see. I'm just going to hit the quick clear button. So I'm current on my questions. And then let me go back over the PowerPoint, see if I've missed anything. Break even, inviting professionals. So I always want to give you a marketing idea. So I want to share with you a marketing idea before we go in and actually do some case studies. And most of you are probably at least somewhat aware of the ability to invite an unlimited number of marketing professionals into the platform. And that's called the partners link right here. So let me show you what that does. When I click the partners link, it takes me over here and shows me my picture. So I know who I am. That's not me, but it's just a picture. And it says Todd's Network. And there's 4 buttons up here. And these buttons have pre-written scripts for you that you can utilize to invite a referral partner to connect with you. When they connect with you, their name is going to show up over here in this list of partners. You can add partners manually yourself by clicking the add button and add a partner, put in their photo and their information and stuff. So you could have, I've had folks tell me their assistant or whatever went through and put all their referral partners in here, even went to their website and grabbed photos and logos and stuff like that. Or you can simply invite a partner, and when that partner connects with you, you'll see them show up over here in your list on the left. Now, the benefit of having a partner in the system, there's several. One of the key benefits is once I add a partner in the system, when I'm doing a plan for the client, and I come over here and I want to assign that particular client to a partner, I can come pick them from the drop-down list in one click, and now they're assigned, this lead is assigned to that partner. That's also critical for open house flyers and seller buy down flyers and stuff, because all the branding, and some people don't realize this, if you have a referral partner that you assign to an open house flyer or seller buyer down, I've assigned this realtor, Carolyn Lucas, as my referral partner. Remember, it's what you see is what you get. If I collapse this lead is still referred to that partner, but that referral partner won't show up on the flyers. It'll have just your information. If I expand the referral partner, assign the flyer to Carolyn Lucas, okay, and I leave this open, then the open house flyers will have my branding and Carolyn's branding. So that gives you the ability to assign something to a financial advisor, but they may not want their logo and personal information on it. So I can simply assign it to, new advisor here, and I want to track it to him, but he doesn't want his information on here. I shrink it up. It's assigned to him. It'll show up in my reports, but it will not show up on any of my marketing materials or flyers or seller buy down, etc. Okay? But I'm going to go back over to the partner section. I see someone saying they don't see the presentation. I only have audio. I'm assuming everybody else can still see the presentation. Harold, that you got to log into the web portion for the web part, and then it should be in the same thing. But if other people aren't seeing audio, okay, you're not seeing the presentation anymore? Stop for 1 second and make sure. Nope. Huh. Well, I'll tell you what. All right, I'll tell you what. Let me stop sharing and I'll restart sharing. Sometimes you have to do that. All right. All right. Others can see it. Okay. Well, I just reshared, started over again. So let me know if someone can just tell me if they're seeing everything now. Roger says he can see it. Anyone else? So just hit me one more saying I can see it. Yep. All right, great. Thank you, guys. All right, so here's some other benefits to think about. We give you an open-ended license to share the software with as many referral partners as you want. What they get, if I click Invite Realtor, it's going to open up my default email program and it's going to preload a pre-written email that I can then go through and edit. So I can go and let's say I was going to send this to Chuck. I would just come in here and say, Dear Chuck. I would delete the top part. Okay, it says, Dear Chuck, as a realtor, I know you want to do everything you can to differentiate yourself, etc. We've recently invested in a new software program. That said, click the link below and create your secure account. Please call me with any questions. After I see you connect, I'll reach out and share a couple of interesting sales ideas with you. So you can customize it however you want, but this link is tied back to you and to that realtor. So when you now put in Chuck's email address and hit send, you've just sent Chuck an invitation. When Chuck clicks that link, it will allow him to go in through a special key and log in and create basically a BSA account. Now, the thing that's different about that account for Chuck as a realtor, think of it like a valet key. A valet key, you can start the engine, you can do certain things, but you can't open the glove compartment of the box. You can't get in the trunk. So with a referral partner, they can actually get a light version and they can see basic presentations and they can access the calculators, but they can't print anything and they can't generate their own reports. What they can also do though, so think about that. If you send this out to a realtor and they connect with you, you can go out and meet with them. And this is my marketing tip for you today. This is a sales strategy that we're seeing people have a lot of success with. All right, here's the marketing idea. Just invite 3 realtors that you know to join your network this week and sending them an invitation from within the software. Once they join, and you'll know they join because when they join, you get an email that says, Chuck Haslett just joined your community. Then you give Chuck a call and say, I'd like to come by and show you a couple of things about the tool that I think you'll like. And what are some of the things that you might show Chuck? You might show Chuck the calculators because Chuck's going to have questions sometimes about payment calculators or extra things. This is some of the stuff I would show Chuck. I would also sit down with Chuck and show him the open house flyers I can create and say, Chuck, here's something I can do for you now. I can go in and create an open house flyer that we can generate for your clients. It'll have finance information. It'll have your information, my information, logos, etc. So what you're really doing is you're showing your referral partners a dramatic way that they can differentiate themselves from you. And they can fully run the software. They just can't actually create a deliverable. They can't create reports or PDFs. But let me tell you, this is a very, very important point. When they connect with you and when they get your link, so let's say I send this email out to Chuck and I invite Chuck and he connects and I get the email back. Something else happens with Chuck. Chuck now shows up in my list of partners that I can transfer plans to. All right, so some of the best practices that we're hearing about is some, loan officers, they don't want to create open house flyers, right? You just want to maybe put in the mortgage information. Or we have some financial advisors that have shared with a loan officer, and the financial advisor puts in the client's basic information, right? They'll go in and put in a little bit of information about the client here, and then they click transfer plan. And they pick the person on the list here that they want to send it to, and they click the send button. And when they click the send button, it'll say this plan has been successfully transferred. That means that plan is now inside your referral partner system, and it's going to be highlighted just like this at the top. It will also send them an email to let them know that they've got a plan in their system from you. So let's think about this a couple different ways. So you're a financial advisor, and you've got a loan officer you work with. You could put your information in, click the transfer plan button, send that to your loan officer. They go in and put the loan information in and click transfer plan and send it right back to you. You now have a finished plan to review with your client, and the loan officer put in the mortgage stuff, and the only thing you did was the manage tab, the first page. Think about this. If you're a great example is realtors that people are working with, what they're doing is the realtor initiates on their side the manage page to you. They go in and click, and you teach them how, right? Go in and click open house flyer and pick anyone that you want. Why don't you start with the property flyer? It's going to automatically be assigned to that referral partner because it's coming from that referral partner. They go in and put in all the real estate stuff that you don't want to put in. The MLS listing, the number of bedrooms, the number of bathrooms, all the little features and stuff like that. Multifamily, it's offered for $350. The address is 123 Main Street, Fox Glove, North Carolina 28906. So think about that. The realtor can put in this information, and that's all they have to do. And then they click the transfer plan button, and they send it to you. And when you share this with a partner, the only person that can ever show up in their transfer plan is you. You lock that person down. You own them. Okay? So that's another critical reason. If a loan officer sends that person something later, you've got them in the system. So now every time that realtor puts in that information and transfers the plan, you get an email, and you get this showing up right here at the top, and you click on it, you know who it's from, and the property stuff is in. You don't need to mess with that. You just come to the borrow tab, and you go in and put in the mortgage information that you want to put in for a couple of scenarios for that flyer, for that client, and then you're done. And you can either transfer it back. That's why we put the send plan to partner on this page. You can generate the flyer, the open house flyer as a flyer, or I can click the send button from here and go ahead and send it to my partner from here. In other words, they did the manage part for me. The realtor did the manage part. She put in the flyer. I did the borrowing information, and now I'm going to transfer it back. I'm not even going to waste the toner to print this, because once I do that, then that realtor can then open that up. Now, and they can view it. Now, they can't print it, remember, because they can't create presentations. So if you want to send them the actual finished presentation, just click open it as a flyer, build your open house flyer like this as a PDF, and then email it to that person, and they're going to have the completed flyer that you just created for them. But you might want to transfer it back to them first so they can go in and look at it and see the numbers and say, why don't we do a 30-year fixed and a 7-year ARM? I don't know that your realtors would be that granular, but if they want to do that, they could give you some feedback. But we have a lot of loan officers collaborating with financial advisors and realtors, and financial advisors collaborating with loan officers, and they're sharing these plans using this very powerful partner referral tool. The other thing it does is if I click on a referral partner, it shows me all the business from that partner. I can see they've sent me 6 open house flyers, 5 purchases, 2 renters, and 13 refinances, and I can see the volume of business. Boy, there's a lot of business back in April, and it's kind of trailed off since then. I can also see every referred client down here below by referral partner, because this sorts them by referral partner. So I can see that Carolyn Lucas sent me all these people, and I'm looking for one of her clients. Oh, it was Mr. and Mrs. Jim Corp. And when I click on them, I can even see the plans when they were last edited and what we did for them. I can then click that plan and say, that's the one I was looking for, the pre-qual from 4/8. And I click Open Plan, and it'll take me right to the main page, and it'll load that plan for me right there. So again, incredibly powerful ways that you can use this in marketing and building your network and your referral base. I have people that tell me they're just every week they're inviting financial advisors, loan officers. Again, you could invite a credit union loan officer, right? They don't have this kind of tool, maybe, and you send them the invitation and say, I tell you what, I'll help you with some plans that you're doing with your clients if you'll make me your first referral partner for anything you can't do. And, I'll send you an invitation. You can have access to the calculators. You can go in and create a plan here. And but just send it to me, and I'll take a look at it. I'll help you out with it. Or use this to send me. This is a lead tool. It's a walkie-talkie. I'll give you a tool that you can use, but when you have a lead, just load them in here and transfer it to me, and I'll take a look at it for you and see what I can do for you. You can create your own scenario desk right through this system with the partner planning tool. All right. So hopefully that's given you some ideas already as you start thinking about, wow, there's a lot of cool stuff I can do with this tool and building out my referral network of people that are connected to me. I did want to tell you we made some further changes to the ARM simulator page. It's a little bit better, a little cleaner than it was before. I won't go into that today. And we're looking at, a couple people wanted to see a comparison. So we're actually looking at stacking it so that if you only show one scenario, it would just show that scenario. But if you're comparing on the repay page, say a current to a 7-year, or you're comparing a 7-year to a 10-year, it'll actually have the 7-year on top and the 10-year on the bottom, because we think we can get 2 on a page pretty comfortably. So we'll let you know when that's live, but you'll see a few little changes we've made to the ARM simulation page. So let's do a couple of case studies. Let's see. I see if there are any new questions. Yeah, Roger, I think we answered that one. The software can be run by the partner. And anytime, it doesn't notify you when they access the software. It only notifies you when they transfer anything to you. You can't see their information, and they can't see your information. So from a privacy standpoint, it was important that if a financial advisor goes in and puts a client in there, that's private to that advisor. You can't see any of that. If they click the transfer button, then they're authorizing you to view it, and all that information is transferred to your system, and you're notified. Can you share with the mortgage broker? Absolutely. If they want to be able to do their own reports, then they could actually upgrade and do their own reports, and they still stay connected to you. But if they don't want to do reports, they just want to connect and partner with you, then you can share it with the broker, and they can collaborate with you on plans. Absolutely. That's part of the way that was designed. We have a couple of financial service companies that have a model of people, small groups of 6 to 8 people that sit in a room, and that's all they do all day long is collaborate with financial advisors on plans. So if a multi-billion-dollar financial service company can do it, you could do it in your local market with 3 or 4 financial advisors and provide probably a much higher level of service even for the same concept. So I got 2 case studies for you today. One I'm going to call a purchase with a car, and the other one I'm going to call a refinance with a target payoff date. So let's pull them up, and I've already loaded these in. These are cases that came in where I changed the information. So the first one here is going to be a purchase, new FHA buyer, and let me kind of share with you the situation. So this client is buying a home for $150,000. All right, I click the add details box. They're not selling a home, so there's nothing coming from the sale, but they've saved $15,000. That's the total amount of money that they had available to buy this house. and they wanted to put down 10% to buy the house, which was going to basically be the entire $15,000. So they would borrow $135,000. So most of this is all calculated for you. I just put in the $15,000 and the 10%, and everything else is good. I changed the name, new FHA buyer. They have $65,000 in income. They're in a 25% state and federal tax bracket. And here's their current situation. They're renting. They have a landlord, and they're paying $650 a month in rent. All right, so this is a really cool thing to remember. You can do these very, very interesting rent versus own comparisons for people that show them the financial benefits or lack thereof of buying a house. Now remember, whenever you see a widget box, it can be different. If I click the widget box next to rent, it says, do you want to put in an annual rent increase percentage? And historically, that's been about 3% a year at the rate of inflation. Does a client pay rental insurance? Because they might not pay that. If they buy a house, they'll pay homeowners. And let's say this particular person was paying about $25 a month in rental insurance. And you've got another box here if there's some other rental expense they're paying that they might want to associate with this property. So I click the Save button. The client also had an auto with GMAC at 7.75. They had a balance of $9,400, and they were paying $365 a month. Next week, we're going to do some more comprehensive debt consolidation scenarios for you. But their goal was to not have to pay rent anymore. So the rent is going to be paid off, right? They won't continue to make this payment. But the auto, they just assumed they would continue to keep that auto. Now, the client has saved $15,000 to buy a new house, but their biggest concern is cash flow. They don't want to see their payment go much over what they spend now for rent. So you got a pretty naive couple here. They're wanting to buy a house. They just don't really know what it's going to cost to buy this house. And they're concerned that their rent payment is going to be going up from $650 to a number that they can't handle. So this is the case as it came in. The question was, should this client put down a larger down payment, the whole $15,000, or should they consider maybe paying off the auto loan because they had enough money to pay off that $9,400 auto loan, which would free up $365 a month? So that's what we're going to compare here. Let's compare what the client was going to get originally, which was a conventional 30-year mortgage, $150,000 contract price, 30-year fixed. They were going to get a 90% LTV loan, which meant they would borrow $135,000. The rate quote was 4.125, right? And you'll notice here, these are color-coded, so this is where you decide if you want to pay off any liabilities or debts. So right now, the client's got rent, and in the green scenario, they're paying off the rent because they're not going to have a landlord anymore, and they're not paying off the auto. So you'll notice the auto is still a liability. So they would be currently they only owe $9,400 to anyone. That's their total debt. If they buy this house, they're going to owe $144, $135 for their new mortgage, and $9,400 for an auto. So their debt's going to be $144. I can see their ratios 16 and 23. I can see their effective cost of borrowing 4.361. I can see their payment, and I click on my little widget box here, and it's got our stuff in here. We got closing costs of $2,500. We've got $1,200 in prepaids. Those aren't going to come back, right? Because it's a purchase. They're going to have to pay those out for the first time. Not going to get that back for some time. They got $125 a month in taxes. That's tax deductible. $35 in property insurance, and they're going to pay $52 a month in mortgage insurance. So I click the Save button, and that gives me my payments, $1,231 a month. So that's a lot higher than the $650 right now, and that was their fear, is they just didn't feel like they could make the jump because their payment was going to double. So the loan officer was losing this client because he was afraid, and they were basically saying, I can't double what we're paying right now. Even though the ratios worked, they weren't emotionally comfortable with this. So we looked at another alternative with an FHA 30-year fixed with no car. So in other words, what we did is we put in the loan amount at 96.5%, and we said, yes, we do want to pay the car off. And we do that by just clicking the yes button. See, if I do no, the car is going to show up here. It's not being paid off, and that flows into all the numbers above and below. If I click yes, that car is now going to be paid off. And you'll see that below in the closing costs and the other stuff. So what we did is you'll notice the closing costs are $2,500. We're including that in the loan. Prepaids are $1,200, but he could include that in the loan. The funding fee of 1% could be included in the loan. Mortgage insurance was high, or taxes and insurance are the same. Mortgage insurance was going to be higher, tax deductible. We put in our 60 payments and 78%. So this is all in there. So we've got a higher payment, but look at the payment difference. Because they were using some of that cash to pay down the auto, the payment was only going to be $1,034.41 now. So that's a big difference. That's over $200 a month, or about $200 a month difference by helping them look at the way they were going to use this money differently. Instead of using this to put a bigger down payment down, let's use it. And look at their borrowing. They were borrowing $144. Now they're borrowing $149. So their borrowing is going up on a relative basis. But when I go to closing costs, you can see that's all spelled out right here. If you go with the conventional 30, you got a down payment of $15,000 plus $4,000 in closing costs. That's $18,700 you're going to need. You've only got 15. You're going to have to come up with another $3,700. But I've got an idea. We're going to do the FHA fixed with no car. So you're going to pay off the car. And notice that shows up right here. See, when I click the above box that says, yes, pay this off, it adds that below as a debt to be paid off. So you only need $5,250 for your down payment, plus your closing costs, plus your prepaids, plus your MI funding fee, minus, right here, your credit, plus what you got to pay off for the car. You need $14,650. You got 15, you're still positive $350 right there. So by looking at this a little differently, rolling in all these costs, including paying off the auto, one of the first things we did is we made the closing costs look more manageable to this customer. They have enough money to do this today. The second thing I want you to look at is the payment difference. They're spending over here $10.15 a month, because if you show multiple liabilities, the software then considers this a multiple liability case. So this is taking your principal and your interest and your mortgage and all of your rent. See, it's showing you're spending $10.15 now. You're not just spending $6.50 in rent. You're spending money for your car payment, etc. You're getting no tax deductions on that car or that rent. You're really spending $10.15 a month. On the 30, you were going to spend $12.31, but after tax, that's $10.71. And the FHA fixed, 30-year fixed with no car, you're spending $10.34 a month, but after taxes, $8.36. So how cool is that? I'm showing them that they could buy this house with an FHA loan, have $350 in their pocket, and on an after-tax basis move their real cash flow to a positive number. They have an extra $179 a month in positive cash flow. So think about that for a second. How are we doing this? We're just showing different ways to display the information to meet the specific needs of a particular client. And they say, gosh, I really like this. If we can do this, this makes sense. But does it make sense financially? Well, let's compare. Because again, if the client said, this looks good, I could live with this, then I'm going to go ahead and get that other noise out of the way and say, okay, you're going to spend $1034.41 a month. That's what you're spending today for all of your other stuff. All right, you're going to spend that amount. In 5 years, does this make sense? How long are you going to be in the house? They say about 7 years. What do you think the house would appreciate at? They're like, I don't know if it's going to appreciate at all. All right, well, I'll tell you what. Let's just say it doesn't appreciate at all. And let's also say that your after-tax savings rate's 0. Let's make this real simple. Does this make sense for you financially over 7 years? Well, here's what you're going to spend in your current scenario, renting and for everything else. And if you want to break this out, you can just expand it to payments here. You can see what was spent on interest, taxes, principal. You say principal, that's principal on the car because they paid the car off over that 7-year period. So the principal's already paid off here because you've already paid the car off. Here, they're still having to pay that car off. So every number is reflected. You're going to spend $74,281 over the next 7 years, okay, to rent and keep your current scenario. In this scenario, you're going to spend $65,328. And again, the way we did it with the payments being the same, I don't have to break that out. It's $86,890, $86,890. It's all right there. You're going to be better off by $8,953, even if the house doesn't appreciate over the next 7 years. If it just appreciates 1% a year, you're going to be better off by almost $20,000 over that same time period. So just wanted to kind of go into some depth here to show you, again, how powerful this is at illustrating different concepts to help move a client through to make a decision. And for this client, this became this prospect, I should say, it became much easier for them to become a client because of the way that they were now viewing at it. They're spending $1015, they're going to spend $1034, but it's not really $1034 after the tax credit. They're going to be spending $836 a month. All right, so that's my case study there. Let me see if you have any questions on that before I go to my next case study. When we click on partners on the plan, does their pic show up when we send out a mortgage analysis? No. Right now, the pictures only show up on the flyers, the finance flyers, seller buy down, or any of the open house flyers. We've had a couple people ask about that, and we might do that if you want to do that. You know, we find a lot of people, they don't want to do that. Especially advisors are skittish about having their picture and their information on a plan that they didn't create. So we've kind of done that as sort of a protective measure for you guys and for the advisor. It's a possibility if you tell us you want it, you think it would really be helpful, it wouldn't be hard to do. We would just basically have a button you turn on that says, you know, apply partner branding to my presentations. Realtors would probably be more interested in that than financial advisors would be. All right, let me do my second plan here. We'll wrap up. We've got about 5 minutes here, and I want to share with you this other case. This is a new refinancer. All right. And let's see, webinar 2. Okay, so this is a $85,000 income. They had a current mortgage of $455,000, and they were paying 5.625% on that. And the client is 55. This came in from a financial advisor. Client's 55, and they want to pay off the mortgage in 10 years. They are paying an extra $500 a month now. Should they refinance? And how much extra would they need to pay to have this paid off in 10 years? So there's really two questions that this client was asking this advisor. Should I refinance? Does that make sense? And what would I need to pay extra to make sure this thing is paid off in 10 years? So everybody with me so far? We've just got a simple mortgage, 30-year, 455 term. All right, and we got a client. So again, I only need 1, 2, 3, 4, 5, 6, 7 blanks, 8 blanks, and I'm done. I go to the bar tab. So I look at the top. The first thing this tells me is the client has 289 months to go. So they've started making some extra payments, but they've still got a good chunk of time, right? Almost 25 years to go before this thing's going to be paid off. So I'm going to do a simple 30-year fixed refinance. Even though they want to pay off in 10 years, I'm going to start off with a 30-year fixed from a cash flow liquidity standpoint. So $460 is the loan amount that I put in here, and I'll show you why. 4.25 is the current rate we put in. All right, and the payment here. This was this could be done as a conventional. I forgot what that's called, but and they were estimating real simply $5,000 in closing costs, and they wanted to include that in the loan. So we clicked include in loan. So you'll notice the loan amount's going from $455 to $460. And that's it. I mean, that's it. You know, there's a tremendous amount of stuff that's been done here, but I'm going to show them first the closing cost impact. If you don't do anything, there's no cost. If you do this, there's $5,000 in closing costs. But you're getting $5,000 at closing, so you have no out-of-pocket. So we've covered again. What are we doing? We're answering that first question. Is this going to make sense for me on a cash basis right now? Well, yeah, so far so good, right? You got no out-of-pocket. Second question, what's the monthly impact? You're spending $28.78 now. You're going to be spending $22.63 with a refinance to this lower rate. So the next thing I can tell you is I'm going to give you $615 a month in positive cash flow starting out by taking this turn. Now, but remember, and this comes up a lot in conversations and even education that I do. When you see a $615 a month payment difference, the client's not really saving $615 a month. They are, but it's not savings. They only have 289 months to go. You just took this mortgage out to 360. So the payment savings here is the interest savings But there's also the fact that you extended their loan by what? By about 60, 70 months. That's a part of that savings too. And this is a key part of answering these questions for your clients to get them excited about moving forward with you, explaining that you know this. All right. Now, this is the trick here I want to show you, because this is a really powerful tool you can use when you're in a conversation like this. Remember, the client wanted to pay this thing off in 10 years. And remember, when you open the widget box, up here in the top, it says to pay off in, and you can put in anything you want here. 300 months, we're already going to be there. 240 months, pay an extra $284. But they want to be paid off in 120 months, 10 years. And the software says you got to pay an extra $20.88 a month. So manually put in $20.88 a month, starting in month 1 until loan is paid off, and click Save. And doing it this way provides a really cool optic for the client. Now look at your new mortgage. I want to pay it off in 120 months, but guess what? To pay the new mortgage off in 120 months only requires $18.34 a month. So put in $18.34 a month starting in month 1 until loan paid off, and click Save. And what have you done here? Look below. The client months to debt free are 120 and 120. So you tell me, you want to be paid off in 10 years. Would you like to keep the mortgage you have today and pay an extra $2,088 a month? Or would you like to go with a new mortgage and pay an extra $18.34 a month? Either case, you're going to be paid off in 10 years or 120 months. And by the way, this is going to save you $30,486 over the next 10 years. So another way to think about showing the value of what you're doing, if someone's wanting to pay a house off, go in and use this tool to see how many months and put that in, and show them the target date, and show them how much more they're going to have to spend on a monthly basis to get paid off in the same time period, and how much you're saving them. All right. And of course, I could go over here and show advanced pay scenarios, and take this out, click Use Same as Borrow tab, and show this 10 years and 10 years, and show the dollars all mapped out. And this just shows me a graphical interpretation of what we just did on the other page, if you want to do that. But these are the kind of stories you want to go out and tell advisors in your local community, tell loan officers, tell realtors, show them what you're doing. Take that case we did before. Sit down with a realtor that you're going to meet with who just signed up as a partner with you. Take this case in, or a case like this, go in and recreate this case and go in and show them an example of how you can help them make sales that would have otherwise not been made, because you can show clients this type of information to help them move forward. So I know our hour is up today. I wanted to give you a couple of case studies, and as always, our goal is going to be to share with you new things we've developed, get your feedback, answer your questions, share with you a couple of case studies and things that will hopefully get you more interested and engaged in the power of the tool and what it can do for you. You can tell power is my word of the day because I seem to be using it over and over. But if you have any questions, let me know. I'll stay on here for a few minutes and handle any further chat questions that come in, any other features you want us to take a look at. And again, we really appreciate you spending some time with us today, and hopefully you picked up a couple new sales ideas or strategies that you can use on a day-to-day basis to increase your conversion rate with your clients. So I wish you all the best. Have a fantastic day. And again, I'll hang out here for a few more minutes and answer any other questions that come in.